Assalamualaikum warahmatullahi wabarakatuh, and a very good morning to Madam Shahida and all of my fellow friends. I'm Amalia Shabila, and my friend Mira will present to you our presentation of a video call regarding inflation. Hello.
Hi Amalia! Are you at home now? Are you busy?
Not so busy. Why? Yes, I'm home, just arrived from work. Is there anything happen, Mira?
Did you know, I just got back from the grocery store and all the prices went up. Even the bread now is very pricey. Don't get me started on other things. Trust me, you wouldn't believe it. I'm so stressed now because I barely receive a bonus, and now that I got it, all the prices are high.
Oh really? Oh my, I haven't been to the grocery store this lately, so I didn't notice about the price. Is their price all rise?
Yes, almost everything is pricey. The bread used to price at 3 ringgit, now it's 5 ringgit.
Oh wait, I think that is what they call inflation.
Inflation? What's that? I don't recall that.
Inflation, remember back in the university we used to learn that inflation is when the price level are all rise to reduce the act of buying goods and services in the current economy. It seems weird, right? Why the seller refused to let people buy more? But yeah, that is inflation. If I'm not mistaken, there is two types of inflation. The first one is demand pull inflation and another one is cost push inflation. Okay, let me tell you in detail. Demand pull inflation is when the demand of the goods is exceed the production capacity. This graph totally shows the trend when this demand pull inflation occurred. As we can see at the first place, the graph still maintains when the demand is just sustained, not so high for a certain product. And when the demand for the product slowly increases, the price will be slowly increased too, as to prevent the product from sold out too fast. But even the price put a bit higher is still great for the economy, as there are still people who would buy the product if they want. But then, when the demand for the product is rapidly growing more and more, it is not good, as it will make the product rapidly run off stock. Perhaps the product were all bought by rich people only, for an ordinary people like us not yet buy even one. So that's why the price will rapidly increase to influence people to buy less, or else it will force their production to work and supply more. Talk about production. Yes, the consumer demand affect the demand pull inflation, while cost of production will affect the cost push inflation, where the production must be related with the labor, the machine, or the raw materials. So when there is a time they need to increase their labor wages, the operation cost, or when the cost of raw materials is high, so they need to increase the price to recover their costs and as well as to maintain their profitability. But then, high inflation is not good to the economy because it will reduce our national output when people refuse to make buying. Can you see in this graph? The consumer demand could be here when the price is at its normal level. But after the increase in aggregate supply that causes the higher in price, it might lower the demand for the goods. So yes, that is the reason why high inflation is not good, because it will lessen the economic stability.
Oh yeah, now I remember. Inflation affects the monetary system too, right?
Okay, I think I don't remember this one. What is that actually?
So, monetary system is a set of laws regarding to the nation's currency and to the mechanisms and institutions by which a government provides money in a country's economy. In a simplest form, it is a system by which a government provides money in a country's economy. Modern monetary system usually includes of the national treasury, the mint, the central bank, and the commercial bank. Now, how does inflation can give impacts to the monetary system? Inflation reduces the value of a dollar over time, which has an influence on the time value of money. The temporal value of money is a principle that outlines how much money you have now is worth more than money you will have tomorrow. First, we will take a look on the impact to central banks. The key indicator for monetary policy for most modern central banks is the rate of inflation in a country. When there's inflation happening, central banks will tighten monetary policy, which is by raising interest rates or adopting other aggressive actions if price increase faster than it is expected. When interest rates are high, borrowing becomes more expensive, which results to limitation in consumption and investment, as both two rely largely on credit. Similarly, if inflation and economic production decrease, the central bank will cut interest rates and make borrowing more affordable, as well as use a variety of other expansionary policy instruments. Then, central bank will do an inflation targeting, which means central bank will do an adjustment to monetary policy in order to achieve a specified annual rate of inflation. Central bank believes that to get a long-term economic growth, a country must achieve a maintained price stability, and that can be achieved by doing a controlling inflation. A general approach of inflation targeting can use all of a central bank's monetary policy tools, including open market operations and discount lending. Inflation targeting differs from central bank techniques that focus on other indicators of economic performance as their major goals, such as currency exchange rate, employment rates, or the rate of nominal gross domestic product growth. When central bank raises the interest rate, savers can earn more on their demand deposit accounts, and they are more willing to postpone their current consumption for the future consumption. Borrowing money, on the other hand, is more expensive, which discourages people to lend, as lending in a modern fractional reserve banking system actually creates new money. Discouraging lending can slow the rate of monetary growth and inflation. On the other hand, if interest rates are low, saving becomes less appealing, borrowing will be more affordable, and spending is likely to rise. Then, commercial bank is also impacted by the inflation. There are situations where the firm had to bear a high cost in production costs, such as raw material, wages, and utility. That results to the customer have to pay a high price for the output. The resulting inflation greatly affects commercial banks. For example, a bank that experiences inflation, government may force them to boost and increase all of the bank's workers' compensation to offset the price that has rises. As the bank raises its salaries, its overhead costs increase. It causes pressure on profits, which can be low. Therefore, in order to compensate for this increase in cost, the bank has to find a way to increase their revenue, which can be done by increasing their transaction fees, the interest rate it charges for loans, or the exchange rate margin. Receiving deposits is one of the main activities of a commercial bank. Depositors will receive a certain interest rate for the money that they borrow, while the bank offers deposited funds on the interbank exchange and receives a corresponding borrowing rate. Both rates are nominal rates, which take inflation into consideration. Thus, the real return is the difference between the nominal rate and the rate of inflation. Therefore, when bank operates suffer from inflation, the bank will suffer from lower real return. Moreover, the bank will also have to increase interest rates for customers that deposited a large amount of funds to avoid them from going to another bank. And then, there are 4 ways to control inflation, which are: first, open market operations. During inflation, Bank Negara Malaysia will sell the bonds, so quantity demand of money decrease, and then the equilibrium will be achieved. Second, reserve ratio. During inflation, Bank Negara Malaysia will increase the nation's reserve ratio, so quantity demand of money decreases, and then the equilibrium will be achieved. Third, discount rate. During inflation, Bank Negara Malaysia will increase the discount rate to achieve equilibrium. Lastly, higher purchase regulation. During inflation, bank will decrease the down payment and period of loan from 9 years to 7 years.
Oh, wow. I can't believe we still remember what we learned in the university back then.
Yeah, me too. It's already Maghrib. I need to shower now. I'll call you again later. Need to go now. Bye!
Oh, okay. Alright. Bye.